The bear case for Montage Gold. Montage Gold Corp has undergone a transformation, evolving from a grassroots exploration story into a large-scale development vehicle tasked with building the Koné Gold Project, KGP, in Côte d'Ivoire. While the prevailing market sentiment remains buoyed by the project's multi-million-ounce reserve base and a management team with a pedigree from successful African miners, a bear case analysis reveals a convergence of structural risks that threaten to undermine the long-term economic viability of the asset for equity holders. Fiscal fragility and the erosion of regulatory stability. The foundational risk to the Montage Gold bear case is the deteriorating fiscal environment within Côte d'Ivoire. Long considered a beacon of stability in West Africa, the jurisdiction is currently undergoing a shift in how it extracts rent from its mineral resources.
The most significant indicator of this shift is the 2025 Finance Act, which fundamentally recalibrated the royalty structure for gold producers. The implementation of a flat 8% ad valorem mining royalty, backdated to January 1, 2025, represents a departure from the previous sliding scale model that ranged from 3% to 6%. This change was not merely a cost increase, but a signal of legislative readiness to unilaterally ignore historical stability clauses in mining conventions when commodity prices reach historic highs. For a project like Koné, which was modeled using a base case gold price of $1,850 per ounce and an all-in sustaining cost of $998 per ounce, the sudden imposition of a higher fixed royalty rate has a compounding effect on margin compression. The previous 3 to 6% sliding scale provided a form of natural hedging. During periods of price weakness, the royalty burden decreased, protecting the margins of marginal, low-grade operations. By moving to a flat 8%, the Ivorian government has prioritized immediate revenue certainties over the long-term profitability of the mines themselves.
The risk of further fiscal contagion remains high as neighboring countries implement similar measures. Burkina Faso and Mali have already adjusted their royalty scales to reach as high as 7% to 8% at elevated gold prices, but Côte d'Ivoire's move to a flat 8% regardless of price indicates a more aggressive stance toward capital-intensive, low-grade projects. The implications for Montage Gold are twofold. First, the retroactive nature of these changes complicates the financial modeling of the project's payback period, which was initially estimated at 2.6 years. Second, it elevates the sovereign risk premium that institutional investors will apply to Ivorian assets. The backdated implementation of the 8% royalty has already forced major producers like Perseus Mining to pay significant tranches of catch-up royalties, totaling $20 million in one 6-month period alone, illustrating the immediate liquidity strain these shifts can cause. Montage, which is still in the pre-revenue phase, faces these increased costs without the benefit of existing cash flow, increasing its reliance on external financing to cover the fiscal gap.
The streaming encumbrance, a structural cap on shareholder returns. While management has been lauded for securing a $825 million financing package that includes $625 million from Wheaton Precious Metals, the terms of this capital are highly restrictive. The bear case argues that Montage has effectively pre-sold its highest quality ounces at a deep discount, capping the potential for equity-driven upside even in a runaway gold market. Under the Wheaton stream, the company must deliver 19.5% of payable gold from the core area of interest until 400,000 ounces are delivered. This captures nearly a fifth of the project's most profitable early years production. The ongoing production payments of 20% of the spot gold price mean that for every ounce delivered to Wheaton, Montage is essentially operating as a contract miner for 20% of the revenue, while bearing 100% of the operational risk, including fuel costs, labor inflation, and processing inefficiencies. Furthermore, the price adjustment mechanism in the Wheaton stream provides that if gold prices exceed $2,700 per ounce or $3,000 per ounce, the production payment is further capped, ensuring that the financier, not the project owner, captures the bulk of the supercycle price benefit. The complexity of the capital structure is further compounded by the Zijin mining stream and various loan facilities that carry significant interest burdens. The total streaming burden, when including Zijin's 3.1% initial stake, means that nearly 23% of all gold produced in the first several years of the Koné project is diverted to third parties at a fraction of its market value. In an inflationary environment where mining costs per ton processed are already trending upward, the unstreamed portion of production must work increasingly hard to cover the project's high-interest debt and sustaining capital.
The Wheaton loan facility, priced at SOFR plus 7.75%, is a particularly expensive source of capital that creates a high hurdle for free cash flow generation, especially if the project faces any commissioning delays. Geological vulnerability, the low-grade margin trap. The Koné Gold Project is fundamentally a high-tonnage, low-grade bulk mining operation. This operational model is notoriously unforgiving of any technical shortfalls. The life of mine (LOM) head grade for the project is a mere 0.72 grams per ton AU, placing it at the lower end of the global grade curve for developing gold mines. While the 2024 UFS improved the early years grade to 1.15 grams per ton through the inclusion of the Gabangago main satellite, the project's long-term viability remains tied to the processing of vast quantities of low-grade ore. Construction complexity and capital expenditure creep. The capital requirements for the Koné Gold Project have been on a consistent upward trajectory. The initial 2022 DFS estimated upfront capex at $544 million, which was revised to $712 million in the 2024 UFS, and by March 2026, the total estimated expenditure had reached $885 million. Capital expenditure commitments. As of late March 2026, Montage reports that approximately 65% of the capital, $572.8 million, has been committed, with $367 million already disbursed. However, this leaves over $518 million in remaining disbursements required before project completion. The target remains for a late Q4 2026 first pour. The recent $25 million increase was attributed to the procurement of 32 megawatt of backup diesel-powered generator sets. This decision, while necessary for operational flexibility, highlights a fundamental risk: the project's potential inability to rely solely on the Ivorian power grid for its 11 million tons per annum processing needs. Reliance on diesel generation would significantly inflate the processing OPEX, which was modeled at $8.94 per ton. If the grid is unstable, the project's AISC could rise by $50 to $100 per ounce solely due to energy costs.
Furthermore, construction at Koné involves massive mechanical complexity, including the installation of a hard rock comminution circuit and an HPGR, high-pressure grinding roll, system. While the ball mill shell was installed in early 2026, the remaining 35% of uncommitted capital is still exposed to late-stage inflationary pressures and supply chain bottlenecks. Any delay beyond the targeted late Q4 2026 first gold pour through the oxide circuit will increase the burn rate of capital, potentially exhausting the $559.4 million in available liquidity and forcing the company into the $75 million standby loan facility provided by Wheaton, a facility that carries a 1.5% annual standby fee just for the right to access the capital. Geopolitical tensions and the Northern Security Corridor. The Koné project is located in the northwest of Côte d'Ivoire, a region that is increasingly proximate to the escalating security crisis in the Sahel. While the project site itself has not yet experienced direct insurgent activity, the broader geopolitical landscape in the Sahelian Security Corridor is deteriorating. The Ivorian government has identified an increased risk of terrorism spillover from neighboring Mali and Burkina Faso. The military's Northern Operational Zone, ZON, maintains 3,000 soldiers on active patrol, and the U.S. has recently integrated Côte d'Ivoire into its global security arrangements. Despite these efforts, recurring security incidents in the Bunkani and Tichalogo regions confirm that the risk of infiltration is real. For a large-scale mining operation like Koné, the security risks include 1. Supply chain interruption. Insurgent activity near the border regions could disrupt the transport of fuel, cyanide, and spare parts coming through northern corridors. 2. Security premiums. The need for enhanced private security forces and specialized counter-terrorism measures on site increases the project's G&A costs. 3. Social and labor tensions. Regional instability often drives internal migration, potentially exacerbating local tensions over employment and artisanal mining rights. In Côte d'Ivoire, artisanal mining supports 500,000 livelihoods and is frequently linked to illegal gold trade, with 40 tons of gold estimated to have been smuggled out in 2022. Any conflict between Montage and local artisanal miners could lead to social unrest and regulatory scrutiny. Political transition and electoral risks.
Côte d'Ivoire is approaching its 2025-2026 presidential election cycle in a tightly controlled political environment, characterized by institutional capture and authoritarian leanings. The exclusion of major opposition figures and the restructuring of the PDCDRA under Tidjane Thiam have created a volatile political atmosphere. Historically, West African election cycles have been precursors to civil unrest or shifts in resource policy. Any post-election instability could lead to a reassessment of the 90% ownership stake Montage holds in the project, or further adjustments to the fiscal code as the government seeks to bolster its popular support through resource nationalism.
Dilution risk from non-core acquisitions. Montage has transitioned from a single-asset developer into a multi-project explorer, recently acquiring African Gold Limited, Didivi project, and securing over 2,000 kilometers squared of tenements in Mauritania. While these are marketed as growth opportunities, the bear case views them as distractions that increase the company's capital burn rate. The 114,699 meters drilled in 2025 and the planned 90,000-meter program for 2026 are highly expensive for a company with no operating cash flow. If construction costs at Koné continue to creep, or if the Mauritania program fails to deliver a discovery, Montage will likely be forced into another highly dilutive equity raise, especially since its current debt levels are already substantial. Leadership transition and corporate governance concerns. While the current management team is led by veterans of Endeavour Mining and London Gold, the bear case notes a potential risk in the high number of new and inexperienced directors flagged in late 2025 reports. The rapid expansion of the leadership team in early 2024 was necessary to support development, but high turnover or a board that lacks independent mining experience could lead to poor capital allocation decisions as the company moves into the operational phase. Furthermore, the significant control exercised by the London Trusts and 19.9% and Zijin Mining 9.9% creates a risk of strategic misalignment. While these shareholders provide financial backing, their long-term interests may not align with retail investors. For instance, Zijin's 3.1% stream and $50 million loan facility give it a creditor priority over common equity holders, and its right of first refusal on future streams could limit Montage's ability to find more favorable financing for its other projects.
The bull case for Montage Gold cannot be divorced from the rapid emergence of Côte d'Ivoire as a strategic hub for mineral investment in West Africa. Historically dominated by its agricultural sector, the Ivorian economy has undergone a structural pivot toward extractive industries, underpinned by a modernized 2014 mining code that aligns with international transparency and investment standards. The country's gold production has experienced a meteoric rise, expanding from approximately 13.2 tons in 2012 to over 59.1 tons in 2024, with government targets aiming to make Côte d'Ivoire Africa's largest gold producer by 2030. This growth is not merely a result of geological luck, but is driven by a deliberate institutional framework, including a digitalized mining cadaster and simplified permitting procedures that have attracted over US $800 million in foreign mining investment in 2023 alone. Côte d'Ivoire offers a competitive advantage in terms of infrastructure that is rare among its West African neighbors.
The government has prioritized regional connectivity, rebuilding major transit arteries such as the road linking the economic capital of Abidjan to the coastal city of San Pedro. This infrastructure is critical for the logistics of mine construction, facilitating the transport of heavy equipment from the port of Abidjan and the port of San Pedro, the latter of which has recently expanded its mineral terminal capacity.
Furthermore, the country is establishing itself as a regional energy hub, utilizing offshore gas discoveries like the Baleine and Callao fields to meet increasing industrial electricity demands. For a high-throughput project like Koné, which requires an 11 MTPA mill, access to a reliable national power grid is a major operating cost mitigator compared to remote projects dependent on self-generated diesel power. The political stability and pro-mining stance of the Ivorian government are evidenced by the rapid awarding of mining permits to Montage Gold.
In July 2024, the Council of Ministers approved permits for both the Koné and Gabangogo deposits, with the official decrees received in August 2024. These licenses are valid for 20 years and 8 years respectively, with provisions for extension as exploration success adds further mine life. This regulatory certainty provides the long-term runway necessary for the multi-decade hub-and-spoke regional strategy envisioned by management.
The Koné Gold Project, Economics of Scale and Simplicity. The Koné Gold Project is characterized by its massive scale and metallurgical simplicity. The 2024 Updated Feasibility Study, UFS, outlines a 16-year mine life with total gold production of 3.57 million ounces. The project's economics are driven by a high-throughput, low-grade philosophy that utilizes an 11 MTPA processing plant to achieve significant economies of scale. The life of mine, LOM, average head grade is 0.72 grams per TAU, but the integration of the Gongogo main satellite deposit, which has a significantly higher grade of 1.45 grams per ton AU, has optimized the early years of the mine plan. The leverage to the gold price is profound. At the base case of $1,850 per ounce, the project generates an attractive after-tax NPV 5% of over $1 billion. However, at a spot gold price of $2,400 per ounce, the NPV nearly doubles, and the IRR jumps to an exceptional 51.2%. Operational de-risking through engineering. The simplicity of the Koné deposit is a primary risk mitigator. The ore body is massive and continuous, allowing for bulk open-pit mining with an exceptionally low LOM strip ratio.
This low strip ratio translates to lower mining costs and reduced sensitivity to fuel price fluctuations. Metallurgically, the ore is highly amenable to standard CIL processing, with average LOM recoveries of 89%. The project's construction strategy, led by Peter Olsen, focuses on early revenue generation through an oxide circuit startup. Construction is currently ahead of schedule, with the oxide sizer already completed and the ball shell installed as of early 2026. By targeting first gold pour through the oxide circuit in late Q4 2026, the company can accelerate cash flow while the more complex hard rock comminution circuit, including HPGR technology, is finalized. This phased approach significantly reduces the technical risks associated with ramping up an 11 MTPA facility. A critical achievement in 2025 was the completion of the project's water management infrastructure. The river abstraction and water storage facilities are fully operational, ensuring a stable water supply for the massive milling operations. Additionally, the tailings storage facility, TSF, lining is tracking ahead of schedule, and the relocation of affected local populations has been completed with a high degree of social buy-in. The procurement of backup diesel-powered generator sets further de-risks the operation, ensuring that the process plant can maintain full nameplate capacity even in the event of grid instability. One of the most significant hurdles for any development stage mining company is the funding gap. Montage Gold addressed this decisively in October 2024 by securing an aggregate $825 million financing package from two strategic heavyweights, Wheaton Precious Metals and Zijin Mining. This package provides more than enough capital to cover the $712 million initial capital expenditure required for Koné, including a substantial contingency buffer. The structure of this financing is beneficial for shareholders. While streaming is often viewed as expensive capital, the Montage package includes significant flexibility and buyback provisions. The Zijin stream is fully redeemable. Montage has the option to buy back 50% or even 100% of the stream starting in 2029, provided certain production and IRR thresholds are met. This allows the company to regain full exposure to its gold production once the project has deleveraged. Furthermore, the Wheaton stream features a crediting mechanism that allows for the reduction of deliveries from the core area if gold is sourced from outside the primary interest area, providing a natural incentive for Montage to integrate new discoveries. The inclusion of Zijin Mining as both a shareholder and a lender is a major validator. As a global major with deep technical expertise, Zijin's $125 million total commitment between the stream and loan followed an exhaustive due diligence process and site visit. This participation, alongside Wheaton's $700 million total package, represents a vote of confidence from the most sophisticated capital providers in the mining sector.
Resource expansion and the hub-and-spoke strategy. The Montage Gold bull case is not restricted to the initial 4 million ounce reserve. The company is executing a hub-and-spoke regional consolidation strategy, utilizing the 11 MTPA Kone mill as a central processing hub for satellite deposits within a trucking radius.
This strategy is modeled after the success of Endeavor mining, where higher-grade satellite feed is used to displace lower-grade material, thereby increasing production and reducing AISC without requiring new large-scale milling infrastructure.
The exploration results reported throughout 2025 and into 2026 have consistently validated this strategy. The company conducted a massive 174,000-meter drilling campaign in 2025, which led to a 24% increase in the overall M&I resource grade to 0.29.
77 grams per ton AU. The M&I resources for higher-grade satellite deposits now stand at 1.25 million ounces at a grade of 1.34 grams per ton AU, providing a high-quality pipeline of ore to supplement the main Kone pit.
Management has set a short-term target of discovering at least 1 million ounces of M&I resources at a grade of over 1 gram per T AU, specifically targeting grades 50% higher than the current Kone deposit.
Achieving this target would have a transformative impact on the mine's cash flow. For context, management estimates that a trucking distance of 75 kilometers results in an impact of only 0.2 grams per TAU on the cutoff grade, meaning that a 1.2 G per T discovery can easily displace 0.7 G per T ore from the main deposit, while still yielding a higher net margin. The company has identified 52 exploration targets across 6 mineralized trends.
This represents a significant increase from the 35 targets identified in mid-2024, highlighting the underexplored nature of the project's land package.
Gabongago-Koroto Trend hosts the Gabongago main deposit and high-potential targets like Gabongago South. Sisedugo Trend, delineating resources for higher-grade satellites such as Kobon North and ANV.
Petit Yao Discovery, a new high-grade discovery being advanced toward a maiden resource in 2026. Wende Property, a 9,000-meter drill program is underway, focusing on step-out and down-dip drilling of historical areas.
The 2026 exploration budget remains robust, with an initial 90,000-meter program already well underway. This sustained investment in the drill bit is a key differentiator for Montage, as it continuously adds low-cost ounces to the mine plan.
Strategic M&A and pipeline development. The Montage team has demonstrated a sophisticated approach to regional consolidation, moving beyond their own permits to acquire and partner with neighboring companies.
These moves are designed to ensure that the 11 MTPA mill is fed with the highest grade ore possible for decades to come. In late 2025, Montage announced the acquisition of African Gold Limited, a transaction that is expected to close in Q2 2026. This acquisition brings the Didievi project into the Montage portfolio. Didievi is a resource stage project with multi-million ounce potential and high-grade zones that average beyond 2 grams per TAU.
The strategic rationale is clear. Didievi could become the next major development asset, providing a second spoke to the Kone hub, or potentially supporting its own standalone operation in the future.
In May 2025, Montage formed a strategic partnership with Aram Resources to strengthen its position along the Bounty Alley Greenstone Belt. This belt is located immediately north of the Kone project, and Aram is currently conducting a 100,000-meter drill program at its Bounty Alley gold project. By investing alongside the London family and Zijin Mining in Aram, Montage has effectively secured a right of first refusal on a significant block of high-grade land that is geologically contiguous with its own permits. Demonstrating its ambition to become a premier multi-asset African gold producer, Montage secured over 2,100 square kilometers of prospective gold exploration tenements in Mauritania in early 2026.
These permits, Safariat and Zednis, were awarded following a competitive tender process and are located along major structural boundaries that host large orogenic gold deposits.
While Kone is the immediate focus, the Mauritania tenements represent the long-term future of the company, providing a second pipeline of projects in another stable and mining-friendly jurisdiction.
Conclusion. The bull case is predicated on three key growth levers that will drive the stock in 2026 and 2027. 1. Construction milestones. As the company moves towards an oxide gold pour in late 2026, each major achievement, mill commissioning, grid connection, will further de-risk the asset and lead to a narrowing of the valuation gap with senior producers. 2. Resource grade migration. The ongoing discovery of higher-grade satellites like Petit Yao and the integration of the Didiavi project will continue to improve the mine's NPV and cash flow profile. 3.
Institutional re-rating. As first gold pour approaches, the stock will likely transition from speculative developer portfolios to generalist producer portfolios, attracting a new wave of capital that has been waiting on the sidelines for production certainty. The projected production of 349,000 ounces per year for the first 3 years at an AISC under $900 per ounce ensures that Montage will be a cash flow generator from day one.
The bull case speculates that in a gold price environment exceeding $2,400 per ounce, the free cash flow generated by Kone will allow Montage to be leveraged, buy back its streams, and fund the development of its regional pipeline, fulfilling its mandate to become the next major African gold producer. The bear case suggests that Montage Gold is facing a series of diminishing returns. The KGP story was built on a $544 million capex and a 3% royalty environment. It is now facing an $885 million capex and an 8% royalty environment.
The unstreamed free cash flow that was supposed to drive shareholder returns is being cannibalized by the Wheaton stream, 19.5%, the Zijin stream, 3.1%, and the host government's 10% free carried interest. When the 0.72 gram per ton head grade is subjected to the reality of 2026 operating costs, the margin for error is nearly non-existent. A 10% rise in fuel prices or a 5% drop in metallurgical recovery could wipe out the project's annual free cash flow entirely.
In this context, the stock's current all-time high valuation is not reflective of the project's true risk-adjusted NPV, but rather a byproduct of the current gold price momentum and a market that has yet to account for the structural leakage of value to the government and the stream holders. The bear case rests on the observation that Montage Gold is a project where the equity value is increasingly subordinated to financial and sovereign obligations.
As the project approaches its first gold pour in late 2026, the transition from a story stock to an earnings stock will likely reveal a much thinner margin than the current 16 Canadian dollar share price implies. That could lead to a significant downward re-rating of the company's market capitalization.